We are in a crypto winter. This is the fifth major drawdown of Bitcoin in the 5 years since I've been in the marketplace. This is a much milder winter than previous winters. It'll be shorter than previous winters. It's going to be followed by a spring and then a glorious summer. So don't fear.
Michael Saylor has confirmed it. We are in a crypto winter. In a recent interview, he described this as the fifth major drawdown he's witnessed in Bitcoin's history. Prices have pulled back sharply from late 2025 highs. Sentiment has cooled. Analysts are debating whether this is just another correction or the start of something deeper. Some forecasts warn Bitcoin could fall further if this cycle mirrors 2018 or 2022. Fear is creeping back into the market, but here's where the story shifts. Saylor doesn't see structural collapse. He sees a season, a reset. He calls this winter milder than previous ones, not a death spiral, but a transition. And he believes spring follows winter. Across the Bitcoin maximalist community, that same conviction echoes. Leaders in the space argue this cycle feels familiar, yet fundamentally different. Institutional capital is here. ETFs are absorbing supply. Corporate treasuries are still allocating. Regulatory clarity is improving. Infrastructure continues to expand quietly in the background. Historically, bear markets flush out leverage and speculation. They strengthen networks. They test conviction. And that's the real divide right now. Traders versus believers. While prices move sideways, foundations are being reinforced. Custody solutions, financial integration, long-term adoption, these don't disappear in winter. They mature. Saylor continues accumulating, signaling confidence not in the next week, but the next decade. The question isn't whether this is winter. The question is, when spring comes, who will still be here? Let's get more of Saylor's insights.
The banking sector is supporting Bitcoin much more strongly today than we were 4 years ago. We've got the formation of digital credit networks, banking credit networks. We've got the support of the administration. We've got a Bitcoin president. We've got 12 cabinet members that are pro-digital assets and pro-innovation. And every single month, you see new advances in the digital asset space, which are bringing extraordinary productivity to the economy and a lot of capital to the asset class.
You know, you're absolutely right when it comes to the banks who have finally started accepting and embracing it. I mean, you could go back, of course, to BlackRock, not a bank, but BlackRock, the world's largest asset manager, finally pushing hard to get a spot Bitcoin ETF in play. IBIT and the rest have done, depending on what Bitcoin is doing, up, down, all around. But let's get to strategy, because your company's average acquisition price for all those Bitcoin is around what, 76,000? Can you just clarify that and make sure that I'm right on that?
Yeah, in that range.
Okay, that is materially above current market levels. And that has created unrealized, albeit unrealized, losses on paper. But at what point, Michael, does this disconnect between cost basis, what you paid, and the current market price become a problem for you and your shareholders?
Yeah, one of the misconceptions people have is that that number really matters. The most important thing to understand is that we bought most of that Bitcoin with equity, not with debt. So if we had borrowed money to buy the Bitcoin, it might be an issue. But we were the largest issuer of equity in 2024 in the entire capital market. We were the largest issuer of equity in 2025 in the entire capital market. I think the company raised $55 billion of capital, but only 8 of the $55 billion was debt. So if we did buy the Bitcoin at a little bit higher than the current level, we sold equity that it was a massive premium to the Bitcoin at the time that we bought it. So the company's balance sheet's a fortress. We're fairly indestructible. Bitcoin can fall to any level. It won't make much difference to us. We will equitize the debt we have over the next 3 to 6 years. We will buy Bitcoin, if not every week, we'll definitely be buying Bitcoin every quarter going forward.
Makes no difference if Bitcoin goes all the way down, and yet your whole strategy is very much based on Bitcoin. I mean, you mentioned your premium. Historically, your stock had traded at a much higher premium than what Bitcoin was at. That is no longer the case. So do you have a framework, Michael, for reclaiming that, I guess, that premium absent any rally in the next, I don't know how long a crypto winter lasts. You said that it would be shorter, but absent any rally in Bitcoin back to 126,000?
Well, our equity is trading at a premium to our net asset value right now. So we've already reclaimed that premium. We've got enough capital for the next 50 to 60 years. So unlike investors that need the market to do what they want in the next month,
capital, I see 2 billion. I see 2 billion of cash.
We have 60 years. We have 60 years of capital, Liz. We can wait out any short-term downturn in the market. A week, a month, a year doesn't matter to us. We're like the company that owns 3.4% of Manhattan with enough capital to hold out to the end of the century. And you're telling me that it's been a bad week or a bad month in Manhattan real estate market. We believe in the future of the network, and we built the balance sheet accordingly.
That's an interesting analogy. I like it. I think it certainly works for people who might not be understanding what's going on. But when you say capital for the next 60 years, in what form?
We have $2.25 billion worth of just cash. And we have Bitcoin, about 717,000 Bitcoin, which is equal to about 55 years worth of dividends.
Okay. All right. That is if they hold up. Given the dividend obligations on preferreds, interest on convertible debt, there's all of that, and your operating costs. What is the pathway through which you would generate actual cash flow independent of Bitcoin?
Yeah, the thing to keep in mind is that Bitcoin is outperforming the S&P by a factor of 2 to 3. And so if you can hold out through a 4-year cycle, then you can expect to outperform the S&P index. We have the option to simply hold the Bitcoin and return the Bitcoin or capital from the Bitcoin to our investors, or we can sell the equity that's backed by the Bitcoin in order to pay the dividend, or we can sell derivatives based upon our Bitcoin holdings in order to pay our dividend. Imagine you take a company public that holds a bunch of Manhattan real estate that you expect to go up 7% a year. Then you sell a preferred stock that pays a 3.5% dividend each year. You're just returning the first half of the capital appreciation of the real estate back to the credit investors in the form of a dividend. If you were holding the same amount in gold and you thought gold would go up 10% a year, you could pay a 5% dividend in a preferred stock. We are holding Bitcoin, which we expect to go up more than 20% a year. So we offer 11% dividend yield on the preferred stock, backed by the Bitcoin that we hold. And so the credit investors are getting the first 11% return on Bitcoin in the form of a credit instrument. The equity investors are getting the return in excess of the 11%. So what we've done with STRC is created a digital credit instrument that can pay double-digit dividends, like 11%, in a return of capital dividend, so it's tax deferred. And then we over-collateralize that credit instrument with $4 to $5 worth of Bitcoin whenever we sell $1 of stretch.
Michael, isn't that based, though, on a blue sky scenario? You began the sentence by saying, imagine if you were in real estate and you expect real estate to go up 10%. Well, in 2005, 6, 7, everybody thought real estate was going to continue to go up, and it did not. It imploded. There are moments in time where these black swan events happen, and I think that it's important for people to understand, what is the backup plan?
Well, that's why we have 2.5 years worth of cash on the balance sheet. So if the market seized up for the next 2.5 years, we just pay cash. That's why we have the 55 years worth of over-collateralization in the Bitcoin. So you're right. If you needed to be perfect in the next week or the next month, there might be risk. We just need to be right over the next decade for the equity to pay off. And we need to be right, sometime in the next 40 or 50 years in order for the credit to be workable.
Let me shift the discussion to the Federal Reserve, because President Trump has nominated Kevin Warsh to be the next Fed chair. There is a question as to whether he will be in a position to cut interest rates. We know President Trump really wants him to, but the economy is holding up, at least for the moment. So, if he holds off on cutting interest rates, which could hurt riskier investments, give me a sense of what you expect to see in that case.
Bitcoin is global digital capital. It's above my pay grade to speculate about where the interest rates will go. But what I'll say is there are three primary drivers of the Bitcoin price that are all bullish. There are those that believe that Bitcoin is a better gold than gold because it's scarce and it's teleportable. And so people that believe in a debasement trade or they want a non-sovereign store of value will buy Bitcoin for the long term for that reason. There are other people that believe in the digital transformation of finance, and they think of Bitcoin as amplified big tech. And then there's a third set of people that want global property, and they simply want the highest, best property in the world that they can move to any country anytime they want. And so Bitcoin's driven by all three of those dynamics, sometimes on different days of the week. And so it defies putting into a simple bucket, but it's going to win for one of those three reasons, regardless of what the macro environment works out to be.